So we're going to look at profit and profit maximization. What should we do? What are decisions we're making when we're trying to add one more unit of production? This is module 52 and 53 in Krugman's book, 52 and 53. So first of all, profit equals total revenue minus total cost. You can see in the curve here, the graph, it's at the equilibrium is where you want to operate. And the question is, what is total cost? It's explicit costs. These are costs that you can see, such as buying a building. Plus implicit costs would be costs of things you give up because you buy the building. So what you're trying to figure out is, if you're going to add one more unit, is it worth it? I mean, this has been a question we've dealt with. So marginal revenue equals total revenue divided by the change in quantity, triangle being change. So explicit costs, again, are going to be costs where you literally hand cash over in a building, and implicit are going to be what you give up. So you give up when you go to college, for example, you can't have a job and you're paying tuition. That would be the implicit cost, would be the job you're giving up. The explicit cost would be the tuition. And there you can see some other examples of explicit and implicit. Okay, so to an economist, the economic profit is going to be the revenue minus both the implicit and the explicit costs. And to an accountant, they're going to look at the total revenue brought in minus the total costs, in the total cost being just explicit, i.e. they're not going to figure in the implicit. So economists and accountants look at the cost of adding one more unit differently. Okay, so this is more the way of looking at it from an accountant's standpoint. If Babette's cafe has a revenue of 100,000, and the explicit costs are 65,000, you expect a profit of 35,000. But an economist would look at it differently. An economist would say, well, there's foregone wages, meaning you've already paid people in the past, and you gotta, or you're giving up being able to pay people other wages because you're investing in, say, a new machine for coffee. I didn't mention depreciation. This is going to be, an accountant would see this, as would an economist. This is the value going down of, say, that coffee machine, because over time it would depreciate, i.e. it has wear and tear, and there are literally amounts that you would take off on your taxes each year. So obviously this whole thing is an accountant's view of it, and the accountant is going to have a much different view of it. So Babette is not doing well if you look at the income that's being given up in addition to what the accountant would look at. So again, you need to look at it and say, well, am I using my resources well? If the resource is being used well, is it a profit from the economic standpoint? Then you go forward. If it's not, then you need to change something or get out of the business. And of course, if it's equal, if you have a normal or you're at the equilibrium, then that's okay too. Ideally, obviously, it's the top box you want. Okay, so here you go. We have the marginal revenue equaling the marginal cost, and the optimal point is right here in the center at 18 bushels, dollars, sorry, per bushel, and then 5 bushels of tomatoes over here, and you want to be here or higher than that if you're in the business from an economist standpoint. And then, of course, notice the second curve, marginal revenue equals, in this case, the price. And that's it. Hope this was helpful.